Good morning, everybody. Welcome to our webinar, All You Need to Know About Transfer Pricing in Zambia. Delighted to be here. I'm Cabrini from Regan van Rooy, and I'm even more delighted to have MMLP legal practitioners joining us and two esteemed speakers who I will introduce to you shortly. This is quite an interesting topic. Zambia is an interesting jurisdiction normally, but in a transfer pricing perspective, there's a lot going on. They've got solid legislation in place, massive penalties for non-compliance, and, really clear guidelines. But as well as that, they actually have case law and precedent in transfer pricing. So there's a lot happening transfer pricing wise in Zambia. So let's just talk a brief intro to what we'll cover today. We'll talk a little about what is transfer pricing. We will give an in-depth review into the transfer pricing rules specific to Zambia. We'll also talk about the documentation requirements. Malenga will take us through the TP dispute resolution process, and hopefully at the end of it, we will have some key takeaways to think about when we finish up afterwards. So as I mentioned, I'm Cabrini. I'm from Regan van Rooy. Regan van Rooy is an international tax and transfer pricing firm. We established back in 2016. We operate across Africa and Europe, and the UAE is one of our new markets. Obviously, there's a lot happening there too. And yes, I've been working in transfer pricing for coming up onto 20 years. I like to say less years because it makes me sound younger, but however, it's been a while. But let me please introduce you to Malenga Shitiba and Shibwewe Malenga Bwala from MMLP. Over to you, Malenga.
Right. Thanks, Cabrini, and welcome everyone to this webinar. I'm Malenga Chiteba. I'm a partner at Malenga Mundash Legal Practitioners, MMLP. So MMLP is a full-service law firm, and we also have a well-established track record in tax litigation as well as tax advisory and compliance services. I head up the tax and corporate advisory practice group, and we have in the past also done some significant work both in disputes as well as advising around transfer pricing matters, both in terms of compliance as well as dispute settlement with the ZRA. I'll ask Chimwemwe to introduce herself. She's an associate in the tax group.
Thank you. So welcome everyone. We're happy to have you here. My name is Chimwemwe Mlengawalia. I'm an associate in the corporate and tax department of Mlenga Mundashi. I've been with the firm since 2019, working on most of the tax matters here. So please enjoy our presentation. And if you have any questions, please feel free to just put the same in the chat box and we'll be able to address the same. Thank you.
Perfect. Thank you so much for that introduction. And it's really great to have you here with us today. So we're going to start with what is transfer pricing? Where did this originate from? Why has it become so important? And why should we all care about it? Big questions. But essentially, as we know, the business world has changed. Internationalization of business is key, and multinational groups have just gotten more complex. So tax authorities over the last decade or so have started to step up and take notice of this, and in particular, notice how groups interact with one another. And as a result of this, transfer pricing has become a critical area of tax and of international business. So it all stemmed, partially at least, from the base erosion and profit shifting project, and the OECD and all the various countries coming together to demand increased tax transparency and to look at setting up a global set of rules for international businesses to comply with. So as a result of that, we've seen a new spate of legislation in many countries, including Zambia, where we've had various updates on the transfer pricing law over the recent years. So we say transfer pricing is the cornerstone of international tax. And why do we say that? It's because transfer pricing models is integral to what profits are realized in which jurisdiction. And ultimately, transfer pricing is like a tug-of-war between the tax authorities, because each tax jurisdiction or each jurisdiction wants to get its fair share of the pie and the appropriate tax to be paid in its jurisdiction. So one of the concepts around transfer pricing, the big picture concept, is that profit, and where you pay tax, should follow value creation. But what's complex about that is determining, how and where that value is created in a group value chain. So taking us back a step, the main principle about transfer pricing is this thing called the arm's length principle. And essentially all it says is that we should transact with our related or connected person in the same way as if it were a third party. And to the extent that we don't transact in such a way, the tax authority can make an adjustment to the profit and the tax payable to align it to the arm's length principle, or what a third party behavior would be like. So transfer pricing, the onus is on the taxpayer to prove that how they do their business is arm's length. And oftentimes when we talk to business, they say, well, it is arm's length. We just treat our sister firms or our partner firms as if they're non-related. And that's all well and good. But the taxpayer actually has to prove this is true through various streams of documentation. So of course, we have our transfer pricing documentation. We have the financial data to support that. We have our legal agreements. And then we have to evidence to the taxpayer that what we say legally, we actually do in substance. We then have to support our transfer pricing with significant people functions. So where certain functions are formed, we have to document and then outline how value is created in our business. And the question is, why does all this matter? And it's because who does what determines where profit should fall. So we figure out who does what in what country, what is the economic significance of what they do in the value chain, and then how much should be paid or remunerated for that, or how profit should be earned. Broadly speaking, transfer pricing is governed by the OECD guidelines. And of course, Zambia has its own set of local legislation, which is broadly aligned with the guidelines, but has certain anomalies. One of the ones, of course, is domestic transfer pricing and the specific penalty requirements. So I was asked this question, who cares about transfer pricing? So obviously the tax authorities care. It is a matter of compliance, and global regulatory bodies such as, foreign exchange approval, and when you operate in highly regulated industries, it is quite key to ensure that you're compliant with all laws, transfer pricing being just one of them. The taxpayers themselves care because, of course, they're left with the compliance burden. But it isn't just the tax team or the tax director, because it actually goes to the C-suite. Why? Because it really relates to where profit is being generated and the kind of robustness of your overall international tax model. Your stakeholders care, and as an example of that, we can refer to the recent Coronation case, which was, a South African and actually an Irish entity involved here. But after a kind of a poor judgment which related to transfer pricing and also CFC issues, there was an immediate drop in the share price. So transfer pricing, is quite impactful for all parties to the business, not just the tax people. The public care, because there's a lot of negative reputational context sometimes associated with transfer pricing, particularly in what might be perceived as developing economies, or where profit might be perceived to be shifted from higher tax jurisdictions to lower tax jurisdictions. So in that, we say transfer pricing, it's a bit more than just compliance, right? You have to implement it into your business. But also, if you have a robust transfer pricing model, you also have opportunities to optimize your business model. And that's sometimes forgotten because transfer pricing is seen as so burdensome and compliance orientated. But if you plan and do your transfer pricing appropriately, there's lots of opportunities still remains to optimize such models. So what we have externally, what are the external forces in terms of the global trends, is we've seen a lot of new legislation. You know, even last week and the week before, we have new releases coming from the OECD around the Pillar 1 and the Pillar 2 situation. And, you know, their concepts are all related to the same premise as transfer pricing. Are we paying tax in the right jurisdictions with our related parties? So the Pillar 1 and the Pillar 2 initiatives are extrinsically linked to transfer pricing concepts. So I often say, if you have a young daughter or son looking for a career, transfer pricing is the place to go, because there's a lot happening in this space, and there will be for international businesses for the foreseeable future. So as a result of all of this law, what else have we seen? We've seen the tax authorities upskilling, right? The transfer pricing is seen as a high value audits. So tax authorities need to make sure that they've got the right skills in place. They are getting assistance from wider, more experienced tax authorities. And when I say more experienced, I mean with respect to transfer pricing, where they might have been dealing for longer with this legislation. There's also been an increase in tax transparency as a rule and as a matter of compliance. So the documentation that is prepared to support transfer pricing is detailed and comprehensive, includes country by country, master file and local file. And not just is this information for sharing with your own tax authority, this information can now be shared between multiple different tax jurisdictions. So that's a lot of complexity and a lot of information that all of a sudden various tax authorities will likely be scrutinizing. So, of course, as a result of this, we've seen an increase in transfer pricing disputes generally, and quite a lot of political interest. There's not one budget in Africa or in most countries now that doesn't reference transfer pricing in its budget speech in one way or the other, with the Pillar 2 or BEPS initiatives. So what does all this mean for you and your Zambian business is, unfortunately, there's a large compliance burden. You know, that compliance burden has increased. Typically, we have a stress on resources. We haven't got, sometimes we struggle in terms of having enough budget for our own internal tax team, never mind transfer pricing specialists. So it's a lot of additional burden. Big picture, because the rules have changed so significantly, groups and businesses are reassessing their business model. Is what we've done for the last 5, 10, 15, 20 years still appropriate? The world has moved on. Has our transfer pricing model and policies moved on? And is it still appropriate and fit for purpose? The other issue that's really changed is transfer pricing documentation going from just being a document that you stick in your cupboard and say, I'm compliant, to actually having it implemented in the business, being ingrained into the business, and making sure that every year that you can evidence that you're actually applying the fact pattern and the principles as is outlined in your documentation. Another kind of key item around your documentation is one thing, but you have your financials, you have your tax returns, and you have your legal agreement. There's lots of different sources of information that's utilized to support your transfer pricing. So it's really important that one considers that all of this data and fact pattern is reconciled so that everything makes sense and ties up together. It's no point having a perfect transfer pricing document if all the evidence and data doesn't support it in the same extent. So just a brief look at what kind of transactions are typically being looked at from a Zambian and global perspective. So later on, Shim will go through, who are your connected persons, that we start with. But then we look at what are the type of transactions that are being looked at. And that's any type of services. You're providing a service to a related party or receiving a service to a related party. Goods, purchase and sale of goods is always a high value one. Intellectual property and intangibles is becoming a more important and more complex transaction that's being scrutinized by tax authority. And of course, your financial transactions, your loans, is the quantum of your loan arm's length. is the interest arm's length. And all of this supports deductibility and so forth, but quite complex. The OECD have issued new guidance, about 6 months ago with respect to financial transactions. So there's been a lot more scrutiny on that in Zambia and in the African countries, whereas before, financial transactions were probably less scrutinized. So the African tax authorities are kind of picking up on that, and we've seen increased scrutiny there and in the intangible space. Services and goods have kind of always been challenged quite regularly. So some of the low-hanging fruit for tax authorities, and particularly in Zambia, and Malenga and Shim will talk us through some of the specific cases that happened there. But the type of transactions that are very regularly challenges are transactions with low tax jurisdictions. That's always a red flag for any tax authority, and you're always likely to get scrutinized there. The key concept of substance and significant people function in the low tax jurisdiction becomes super critical in terms of a defense. Tax authorities are also very aggressive towards continuously loss-making entities and entities that fluctuate regularly in terms of their profit. They're often kind of an easy one. And what's important is to always remember your transfer pricing documentation should explain your profit position. It should explain it in the context of the wider business, because there's often a defense that can be made for loss-making entities, and we've even seen that recently with the case law. But you should actually contain that in your documentation narrative to avoid potential audit going further. High value transactions, I think this is an obvious one. So we often look in Zambia at, what are the key economic drivers in Zambia? That's the area that the tax authorities tend to focus. Where do we see a lot of exports of goods, commodities, and so forth? They're high value transactions. Royalties and loans also, but goods is normally the highest value transaction across the board, depending on the nature of your business. Another low-hanging fruit that's often checked is how much of your business is related party. So if you're buying all of your raw materials from related parties, or 90%, or a bulk of your revenue is related to sales to a connected person, there's quite a high likelihood of being examined from a transfer pricing perspective, because most of your business is transfer pricing related. One area that people often forget is restructuring or M&A or acquisitions. Any changes to the group structure can be considered a restructure under the OECD guidelines, and your TP model always needs to be reassessed when you have that. For example, have we transferred anything of value out to another jurisdiction, and so forth. And the big thing here is without documentation, without transfer pricing documentation, you are left sorely on the back foot, and essentially we say without a defense. And we've seen this in many case law where we didn't have the right documentation in place, and the tax authorities, because the onus of proof is on the taxpayers, the tax authorities essentially had a field day and kind of went in with their own narrative and went in with their own set of analysis and said, you didn't actually submit anything or have a narrative to give to us, so we're going to have free rein. That's not a position that any business with international operations wants to be in, because we've seen many fingers being very badly burnt. So quickly, just in terms of the transfer pricing life cycle, we think we have a policy and we design our policy. And first of all, we check, is this policy appropriate? Are we, is it right? Have we checked it? Is it updated for all the new global rules? What will Pillar 1, Pillar 2 mean to the policy? But essentially, we have our policy and we set our policy. Then we have to do our annual local files and master files and your benchmarking studies, and actually test every year what we're doing is arm's length. And then we have this dispute resolution and controversy management, which generally people hope to avoid, of course. But it's close to impossible to avoid in some circumstances. But that's what Malenga will talk us through later. What's the dispute resolution process in Zambia? And along this life cycle, what's important is what we call operational TP. Are we doing what we say we're doing in our documentation? Are we ingraining our process into our business? Do we have the evidence to support that what we say we're doing? And are we implementing this and monitoring it on an ongoing basis? Because TP is, it's how we price things within our business. It's how we pay for things. It's how we recharge for things when we have group transactions. So it's pretty key that we've thought about the processes that are required to make it work properly. So that's a bit of an overview for general transfer pricing. And now I am delighted to hand you over to Shimwiwe to kind of dig quite deep into the Zambian transfer pricing rules themselves. Over to you.
Thank you, Cabrini. So I'm just going to give you a brief overview of the regulation of transfer pricing in Zambia. And as stated earlier, please feel free to just ask your questions in the chat box and we'll be able to attend to the same. So I'll start from the genesis of transfer pricing in Zambia, which actually was introduced in 1999 through the Income Tax Amendment Act number 6 of 1999, which shows that the transfer pricing rules have been in effect in Zambia for a very long time. So a review of the provisions that relate to transfer pricing will show that amendments are made almost every year. So there are several amendments that are made. So it's so important for taxpayers to be aware of the same. And as Cabrini had mentioned earlier, ignorance is never a defense in this case. And I think that's why we're even presenting this. So the most recent amendment in relation to the transfer pricing rules came into effect this year on 1st January, and I'll briefly touch on that as it relates to foreign tax credits. So I'll mention that later on. The key provisions in relation to transfer pricing can be found in the Income Tax Act in sections 97A to 97D of the Income Tax Act, and this is the cornerstone of transfer pricing regulation in Zambia. So what complements this legislative framework are the transfer pricing regulations of 2000. So what these regulations do is that they play a vital role in providing detailed guidelines and procedural requirements when it comes to the implementation of transfer pricing rules. So a very notable amendment that was made here in Zambia occurred on 6 April 2018. So what this did is that it aligned the Zambian transfer pricing rules with what's happening internationally. How did that happen? So if you look at Zambia's transfer pricing rules now, they align with what's provided for in the OECD transfer pricing guidelines. And if you also look at the amendments that have been made since then, Zambia ensures the policymakers make sure to make the amendments that align what's provided for here in Zambia with what's happening internationally. So in terms of legal hierarchy, as you heard Cabrini mention, several amendments are made by the OECD. So what happens in the event that there's inconsistency with what the OECD has provided and also what's provided for in Zambia's Income Tax Act and the regulations? So in this case, Zambia's Income Tax Act and its regulations take precedence. So this is very relevant when it comes to legislative interpretation. Then the ZRA also provides guidance on such issues, and a very notable practice note that was issued by the ZRA being the Zambia Revenue Authority, which is the tax authority here in Zambia, was a ZRA practice note number 2 of 2018. But following that, the ZRA has also issued several practice notes just to provide guidance to taxpayers. So in relation to the objectives, it's important before we even delve into the applicable provisions, it's important to understand what are the objectives of the transfer pricing rules and what are the implications of these transfer pricing rules. So it's important to understand that this is actually quite multifaceted with the main aim being to safeguard Zambia's fiscal stability. So the primary objective here in Zambia is to identify and address transfer pricing practices that could potentially erode Zambia's tax base. So the whole purpose of this is to protect Zambia's fiscal health. So what the ZRA does in this case, the Zambia Revenue Authority, is it scrutinizes intra-group transactions. What the authority wants to do in this case is to prevent profit shifting between jurisdictions and to also just ensure that the companies operating here in Zambia pay their fair share of taxes. So what you note from the transfer pricing rules is that they have very, very comprehensive coverage in that they apply to domestic control transactions and also to cross-border control transactions. So I'll explain what control transactions mean soon. So the whole purpose of this is to understand that once a transaction is considered a controlled transaction, it will be subject to scrutiny by tax authorities. So this is why it's important to understand what the objectives of these rules are and understand whether any transactions that you enter into would qualify as a controlled transaction. So the entire purpose of this act is to prevent tax evasion, tax avoidance, and this is something that happens, as we'll provide you with some examples in case law, and this happened here in Zambia. So just to give you a general overview of Zambia's transfer pricing rules, I'll explain what rules apply, to whom they apply, and also why these rules apply. So who do these rules apply to? So for us to understand this, we'll be looking at the Income Tax Act, and in particular, Section 97A. So what Section 97A does in this case is it provides that for the transfer pricing rules to apply, two elements must be met. One, there has to be a presence of related or associated persons, and two, there must be the presence of a controlled transaction. So who are related or associated persons? So I'll just call them related persons. So in this case, this term just typically refers to any entities that have some form of a close connection, where through this could be through the ownership, it could be through control or other relationships. So to give you some examples of this, we could look at parent companies, sister companies, subsidiaries, or other entities that have common ownership or control. So the tax authorities look at this. Now, when it comes to control transactions, this is a very, very easy definition. Once you determine who the related parties are, all you have to do is ask, were there any transactions between these related parties? Once you determine that there were transactions, that's basically a controlled transaction. It's a transaction between related entities. So Cabrini had given us some examples of that earlier, which is basically the sale of goods between related parties, the provision of services, the transfer of intangibles. So that's basically what a controlled transaction is. So now when it comes to what must be done, so once you determine who a related party is and that there is a controlled transaction, what happens in this case is that these related parties who engage in controlled transactions must ensure to comply with Zambia's transfer pricing rules. So Cabrini had stated why that's important. The whole purpose is to ensure that these related parties enter into transactions at arm's length. So the Income Tax Act and the transfer pricing regulations are aligned with the OECD guidelines, as I had stated earlier, and this was introduced in 2018. So Cabrini will provide further detail later on, but something that you just must be aware of is that Zambia's transfer pricing documentation mechanism takes after what's provided for in the OECD guidelines, which is a three-tiered approach. So the first thing is the requirement to have a master file. The second is to have a local file, and the third to have a country-by-country report. So just a brief overview, but Cabrini will provide further detail, is that a master file is basically a comprehensive document that will provide an overview of the global business operations and transfer pricing policies of the multinational enterprise. While when it comes to the local file, this will focus on the specific transactions between the related entities that are operating here in Zambia. Then with respect to the country-by-country report, so this one provides for key financial and tax information, and further detail will be provided, but it's important to note that this requirement, when it comes to the country-by-country report, is only applicable to multinational entities with a consolidated group revenue exceeding 4,795 kwacha. So why we're providing with this is 4,795 million kwacha. So you need to ensure that you check with the company financial statements to see whether or not you have to comply with this requirement. So the reason why we're doing this and the reason why we are providing this information is because the penalties when it comes to non-compliance are extremely hefty. extremely hefty. So the company and the group as a whole will not only be subject to reputational damage, but what happens in this case is that, so in cases where the ZRA looks at your transfer pricing documentation is not compliant, or where you're not compliant with these rules, there are tax audits. So following these tax audits, the ZRA will make assessments, and they could make adverse assessments in this case, which could affect you. And in addition to that, there are also penalties, which could go up to 24 million kwacha here in Zambia. So this would just be in Zambia. And one thing you also need to take note of, and Cabrini had mentioned that earlier, is that there's exchange of information between tax authorities. So for companies which are part of a group, you could also be subject to penalties elsewhere. So that's why we just want to ensure that people are compliant. So not all entities here in Zambia are subject to the transfer pricing rules. So when it comes to exemptions, this being the entities that are not required to submit the transfer pricing documentation that I mentioned earlier. So firstly, these entities which would be subject to the exemption have to be tax residents. So they would be exempt. So tax residents here in Zambia would be exempt from submitting transfer pricing documentation if they are not multinational enterprises, and also if their turnover is below 50 million kwacha. So this is something that's important to take note of. However, this 50 million threshold, this 50 million kwacha threshold will not apply if an entity is part of a multinational group, even if it falls below the turnover. Why is that? Because the tax authorities still need to regulate controlled transactions. So you can't say because you fall below that threshold, you don't need to comply. No, in this case, you still need to comply. So it's also important to understand that when it comes to related domestic parties, so parties that are resident here in Zambia and that enter into transactions as related parties, control transactions for that, it's important to note that in this case, if these parties are solely engaged in transfer pricing, controlled transactions, in this case, they won't be required to submit documentation. However, the transfer pricing rules will still apply. I know this would seem confusing, but again, remember, what is the purpose? This is to ensure that as related entities, all the transactions that you engage in are entered into at an arm's length, because the whole purpose of the transfer pricing rules is to ensure fair dealing for everyone across the board. So even if you're just engaged in transactions here in Zambia, you would still be required to comply with the transfer pricing rules. So some other important provisions, and this is very important. So earlier on, I had mentioned that we had a recent amendment in relation to foreign tax credits, which came into effect on 1st January 2024. So this related to foreign tax credits. And for those who don't understand what foreign tax credits are, basically, this is a mechanism that's employed by tax authorities to relieve entities from double taxation. So this being entities that would be subject to taxation in more than one jurisdiction. So in this case, it allows foreign taxpayers to offset their taxes, which were paid to foreign governments, against their domestic tax liability here in Zambia. So in relation to transfer pricing, this is important because we're dealing with related entities that engage in cross-border transactions. So this would be very relevant. So how do the transfer pricing rules apply to this? So this is provided for in section 97A11. So what this provides, and these are provisions that have been there for quite some time. So I'll get to the amendment. So basically, these provisions just simply state that foreign tax should not be paid if the income on which it was charged was generated at arm's length. So back to that terminology, the arm's length principle. And in this case, the burden of proof lies with the taxpayer to show that that income on which the tax was charged, was at arm's length between the controlled entities. So it's important to really ensure that all transactions that you enter into at arm's length. But how would you be able to do that? Through documentation. So this is the documentation that we mentioned. Ensure that you keep the documentation in place. So, and it's also important to take into account the new amendment that was made. So this is in relation to the cases that are under litigation. So why is that important? Previously, the transfer pricing rules provided that when it comes to the time limit, there is a time limit. So a time limit for when you can claim the foreign tax credit. What is that time limit? It's 12 months from the date of assessment. So this is what happens. The tax authority will issue an assessment, and within 12 months, you must claim a foreign tax credit. But then when it comes to dispute resolution, and I'm sure this is the same in other jurisdictions, but here in Zambia, some cases could take years. So what happens if the date of assessment occurred several years ago and this provision provides for 12 months? Well, in this case, the new amendment does provide clarification, and it states that in cases under litigation before the tax appeal tribunal or before the Supreme Court, what happens in this case is that the date of assessment will be the date when the court orders its ruling, when it makes its determination. So it's important to just note that distinction when matters are under litigation, and also just general notices of assessment that are issued by the ZRA. So now, if you look at when we look at Zambia's transfer pricing rules, as I had stated, these are aligned with international standards. And these rules, there's a well-established regime here in Zambia. However, one of the issues that you'll note if you practice tax law here in Zambia is that the judicial precedent here in Zambia in relation to transfer pricing cases is actually not well developed. This is because we do not have many transfer pricing cases. But I'll just highlight two of the significant transfer pricing cases that we have here in Zambia. So this being the Mopani versus ZRA case, which was held down by the Supreme Court, and also the Nestle case, which is a tax appeal tribunal ruling. So in relation to the Mopani case, I'll just give you a brief overview of that case and also the holding. So these are quite interesting cases, and you'll be able to see the interplay. So in the Mopani case, you'll be able to see the interplay between the general anti-avoidance provisions in the Income Tax Act, this being Section 95, and taking into account that the transfer pricing provisions, which are anti-avoidance provisions, are found in Section 97 A to D. So you'll be able to see the interplay between those two provisions. So just a brief overview is basically that the ZRA undertook an audit of Mopani copper mines. So following the audit, so what the ZRA was looking at in this case, it was basically cost, revenue, and the transfer pricing practices. So following this audit, the ZRA issued a report, and in that report, the ZRA stated that it had discovered that there were several transactions between Mopani and its shareholder Glencore. Now, one of the issues that was raised by the ZRA in this case, which is the subject of this particular case, is that Mopani was selling copper to Glencore at a lower price compared to the price that it was selling to other third parties. And the ZRA raised issue with this. So basically, the ZRA was stating that the prices at which Mopani was selling the copper to Glencore were not at arm's length. And Mopani raised issue with the Commissioner General, raised issue before the Tax Appeals Tribunal, and this matter went all the way to the Supreme Court. So what Mopani argued before the Supreme Court is it raised issue with the law that the ZRA had relied on, as I stated, which was the General Anti-Avoidance Rule, Section 95, as opposed to using Section 97A and Section 97D. So that's why we gave you an overview to just understand that. So now, if you look at Section 95, what was the issue here? So Mopani was basically saying that the ZRA wrongly invoked the general avoidance provision, Section 95, in this case, because the ZRA was stating that the main purpose of the transaction between Glencore and also between Mopani and Glencore was to avoid or reduce their tax liability when that wasn't the main purpose. And this provision states that the Commissioner General, the ZRA, needs to have a reasonable belief that this tax avoidance was entered into for the main purpose of the tax avoidance, reducing the liability. So Mopani said, no, this was wrongly invoked. You should have used other provisions. But then in this case, the Supreme Court did agree with the ZRA and said, no, the ZRA rightly used this provision, because if you look at the report and just the operations between Glencore and also between Glencore and Mopani, it's quite clear that the ZRA did have the power based on the law and there was a reasonable suspicion, and the Commissioner General had a power based on what Section 95 provides to raise this assessment. And also looking at what the audit report found, the ZRA did hold in favor of what the ZRA said. So it's a very interesting case. I think it just shows the alignment between Section 95 and the transfer pricing provisions. So another interesting case that we wanted to bring to your attention is the case of Nestle versus the ZRA. So in this case, so I think what's interesting about this case is that now this case explains the transfer pricing principles better, and it also shows the alignment of Zambia's transfer pricing principles with international standards, because this case heavily relied on what is provided for in the OECD guidelines. So just a very brief summary of this to help you understand. In this case, Nestle appealed the tax appeals tribunal similar to the Mopani case against the ZRA's assessment following a tax audit. So some of the arguments that Nestle had raised in this case basically was that the ZRA had wrongly assessed it when it found it liable for additional tax because it was compliant with the principle, with the arm's length principle, but the ZRA had not properly applied this principle looking at the report. Further, that when the ZRA issued its assessment, the ZRA stated that Nestle could not run at a loss since its incorporation. So Nestle said, we don't know why the ZRA stated this, even though we provided proof of this. So the ZRA is provided with proof, but then they just refused. So another issue that Nestle had also raised is that the ZRA failed to objectively test the related party transactions. So Cabrini will take you through the particular test, but it's important to understand that even when you have this documentation in place, tests have been carried out. But in this case, the ZRA did not conduct this test objectively, but then it just raised this transfer pricing concerns. So according to Nestle, the ZRA simply made assumptions and estimates, which were simply excessive and unreasonable. So in turn, the ZRA simply argued that it had carried out the adequate tests on all the related party transactions, that the transactions that Nestle entered into were in violation of the arm's length principle. And also a very interesting argument was that the assessments were made under the Income Tax Act, which meant that they did not just look at any estimates, or they did not make assumptions. So that was basically their arguments in a nutshell. So the tribunal in this case, unlike the Mopani case, held in favor of the taxpayer. So it did hold in favor of Nestle, and basically the ruling was that the ZRA did wrongly arrive at its assessment, and the reason for that is that it used inaccurate transfer pricing results. Now you see the importance of using accurate transfer pricing results. That's where now tax compliance comes in. You need to ensure that you've used the appropriate methods. The Tax Appeals Tribunal also stated that as a result, like how it got to these results was that it simply used inappropriate transfer pricing methods. The OECD provides these methods. These methods are also provided for in our law, so there's no reason for this to happen. So as a result of that, the Supreme Court held in favor. And the Supreme Court also, the Tax Appeals Tribunal also stated that the ZRA had used disproportionate comparables. So the importance of this case, I think for Zambia, is we want you to understand that if you get tax practitioners who have an understanding of the law, they will ensure that everything that you're doing, that you are compliant with the regulations and taking into account the fact that these regulations are constantly changing. So as I stated earlier, Cabrini will take us into the further details that are required. So thank you.
Great. Thanks, Jim. Very insightful. I mean, with the case law, it's always nice that we have, one for the tax authority and one for the business. But even though there's not a lot of case law there, in Africa generally, there's so little precedent. So we're kind of grabbing on to every bit of precedent that we have when it comes to TP across the continent. And oftentimes with disputes, we indeed have to leverage from global case law, because what we've seen is even though there's a hesitancy in Zambia or in other African countries to apply the OECD guidelines, when it gets to court cases, those principles are being applied, because we cannot say, we're aligning to international best practices and then fight against those principles to the benefit of the tax authority at a later stage. So, you know, all in all, it's a good thing that we do continue to see more, you know, precedent in Zambia and other jurisdictions that helps kind of formalize, you know, key risk factors and key approaches when it comes to transfer pricing across the continent. Okay, I'm just quickly going to run through this and then I'm going to hand it over to Malenga. We're running quite short on time. So basically we talked about, you know, this documentation. Some of you here are way too familiar with what a local file and a master file is, and some might it might be more new. So just in general, what your local file is, it's this document that supports the arm's length nature of your transactions. And it contains certain OECD and Zambian legislative requirements, and it's got to contain these to be compliant, right? Sometimes people try to do, you know, a shortcut when it comes to documentation, but one of the key factors that we see more and more regularly is don't take a shortcut on your documentation. This is your narrative to your tax authority. Make sure you've done your homework. You know what's in there, you know what's not in there, and of course take a strategic approach to compliance, but definitely it's an area that's worth making sure you get right. Later, it can save a lot of headaches if you get into the dispute and controversy area. So essentially, obviously, you describe the business, you describe the specific intercompany transactions in quite a bit of detail. When we do this thing called the functional asset and risk analysis, which basically defines and classifies from a transfer pricing perspective the roles of the parties to the transaction. Are they a limited risk distributor or a limited risk type entity, like was the argument in the Nestle case? What's your functional profile? Because like we talked about earlier, your functional profile and your economic significance in the value chain leads you to what an appropriate remuneration is. The second key item that goes into your local file is this thing called selection of a transfer pricing method. There's a number of different transfer pricing methods, but there's not a ton. There's 5, 6 or so that can be used OECD or locally. You have to slot your transfer pricing into one of these methods, and each method can have a different financial outcome. So you have to choose the appropriate method. And there's also a set of rules to determine what's the appropriate method. But we've seen a lot of case law across Africa where the tax authorities have challenged the method. And we've seen successes from both sides of the equation, both from the business and the tax authority perspective. But your method is actually significantly more important than we sometimes think, simply because you're going to get a total different financial outcome if you use a different method. So there's a whole technical discussion to be had around method, but just to bear in mind, it's actually quite a critical part of the analysis. The last part then, the last big part is, of course, your benchmarking studies. You know, this is when you use an independent database to find independent comparables and create a range of results that the tested party or the local entity's profit or transaction can be tested against. Without these type of benchmarking studies and transfer pricing economic support, you cannot conclude or evidence the arm's length nature of the transactions. So these are kind of core components that are quite TP technical in terms of you have to have the right database. In Africa, we typically use the Orbis database because it has global comparables. It seems to be the preferred one by the tax authorities now. And of course, some countries, including Zambia, will often look for local comparables. And the argument being, we just don't have that data available to us, which is why we rely on global. There isn't enough publicly available financial information locally available. So therefore, we generally, we use global and make certain country adjustments, right? Comparability, making sure that we're comparing like for like, how you transact with your related party to what this independent data is telling you. So your local file, yep, has quite a lot in it, but they're the key points. The master file, as we said, is a group-wide documentation. It doesn't evidence the arm's length nature of your transactions. That's the local file. but it provides a lot of group information. And sometimes we don't think, how will that impact us locally when we've done it from a group perspective and maybe we're just a smaller subsidiary? Is there anything in that master file that's actually detrimental to our business position there? Are there people in other jurisdictions using a different transfer pricing model than us? And we're just sitting here and the tax authority might, find out about this when they read this master file that nobody else has read. But basically the master file describes how the group operates. Where's your locations? Where do you make money? What's your kind of structure? How do you deal with financial transactions? What's your financial policies? And what's your intangible strategy? So we talked about intangibles earlier as becoming more of a issue that's being disputed across the globe. And a number of cases now coming to the top in Africa is around, what are intangibles? Have we defined these intangibles in our business? Because essentially that's kind of the complex part sometimes. If we're not Coca-Cola, where it might be obvious, we're somebody else. Do we have intangibles? Who owns that intangibles? Where is it legally owned? Where is it economically owned? Should we be charging for it? Should we be paying for it? What's our strategy around this and all of that? Businesses tend to be behind on this front. That's why, BEPS had its whole specific action points specifically on intangibles, hard to value intangibles. And there tends to be generally quite a lot of work to do around that, because it's not just your legally registered stuff. It's this other stuff that hasn't yet fully been defined, but likely has significant value within the business. So your master file for many businesses is often the first time that they have to put pen to paper and say, what is my intangible strategy? What are these intangibles? Where are they? Do I have intellectual property around the processes, the manufacturing processes, the know-how, the brand? Where is it registered? Do we share out the costs? Have we, what does our intangible structure look like? So it's these kind of core concepts that go into a master file that really don't seem like tax a lot of the time, right? Transfer pricing is unique in that it is a factual business perspective containing a lot of economic data and ultimately numbers, right? But it is a document that clear effort should be put into it and strategic thinking should be put into it, because this master file could be shared with any other jurisdiction. And specifically, if we're part of a larger multinational in Zambia, we should ensure that we've read this document and that we're not being exposed to anything locally for the fact in which way the master file is depicted. But these are the documents, the annual requirements in Zambia. Without having these documents, we're getting into those gigantic penalties that we talked about earlier. You need to have the documents, assuming that you're not falling under the exemption rules. And it will certainly hopefully stand the test of time after a while, because there's a lot of easy money in terms of penalties for not having these done at the right time in the right way. Okay, now I'm going to hand it over to Malenga for the TP dispute resolution process. Over to you.
All right, thanks, Cabrini. So I'll just run through the the dispute resolution process when it comes to transfer pricing. The starting point with regards to the dispute resolution process is that you obviously receive an assessment from the ZRA, which would then indicate what your tax liability is arising out of usually an audit that has been carried out. But perhaps it's important to take a step back and just understand what the internal ZRA ecosystem is around these transfer pricing audits. In the recent past, there has been some scrutiny and discussion around the capacity of the ZRA to carry out these audits, as well as undertake transfer pricing assessments, particularly with regards to the mines. But as Cabrini pointed out, there has been quite a lot of investment in capacity building, including through the Africa Tax Administration Forum, whose responsibility it is to upskill African tax authorities. So the transfer pricing unit of the ZRA is actually quite robust. Now, the way that it is set up is that under the Office of the Commissioner Domestic Taxes, that's the commissioner that deals with all domestic taxes, including income tax and transfer pricing. you have a large and specialized taxpayer office. Obviously, large and specialized makes sense from the point of view that you're dealing with multinationals and in most cases when it comes to transfer pricing matters. And under that large and specialized taxpayer office, you have an international taxation unit that would then typically carry out the audits related to transfer pricing. Now, the starting point is that you will receive an audit report. You will receive findings of an audit report on which you as the taxpayer would be invited to comment before a final position is then communicated by the international taxation unit in terms of what your transfer pricing assessment is. Following that initial assessment, a taxpayer then has 30 days within which to object to the assessment to the Commissioner General. As has been pointed out earlier, with regards to tax assessments as well as transfer pricing assessments in particular, the burden of disproving an assessment rests on the taxpayer. So therefore, it's once an assessment is issued, you as the taxpayer have to then prove that you are in fact tax compliant. And this is where the question of documentation is quite paramount. Now, although it states that you go immediately to the Office of the Commissioner General, in practice, you would typically have the initial assessment issued by the International Taxation Unit, and your initial appeal would typically be to the Commissioner of Domestic Taxes before it then goes to the Office of the Commissioner General. So there is some time for engagement, but in that engagement, it is important to note that you have to make sure that your documentation is in order for you to have an effective defense against your assessment, or in order to be able to discharge that assessment. Now, at the point that the matter is then escalated to the Office of the Commissioner General, the Office of the Commissioner General has a specialized tax appeals office, which deals with all tax appeals that are directed to the Office of the Commissioner General, not only in relation to transfer pricing, but also in relation to other tax types. Now, under this tax appeals office, the taxpayer then has the opportunity to engage with the officers under that office. It's a fairly informal process, but there has to be an exchange of information around the evidence that the taxpayer has in order to discharge this assessment that has been issued against them. And so it's important that at this stage you present all available evidence in order to enable the taxpayer office come up with a recommendation, which will then be given to the Commissioner General before he can then issue a final assessment. Now, once you have a final recommendation and an assessment from the Commissioner General, that then becomes the position of the ZRA. And in Zambia, we have a principle which is called pay now and argue later, which means that once an assessment is issued, particularly by the Office of the Commissioner General, then a taxpayer is required to pay it, notwithstanding the fact that they intend to appeal or they have appealed to the Tax Appeals Tribunal. The position previously is that the predecessor to the Tax Appeals Tribunal, which was called the Revenue Appeals Tribunal, used to grant stays of tax assessments based on its inherent jurisdiction. However, there has been some case law from the Supreme Court where the Supreme Court has taken the position that there is no express power granted to the tribunal to halt an assessment once it's been issued. Therefore, you must be mindful that once an assessment is issued, you have to pay the assessment, notwithstanding an appeal. And that's why it's important to ensure that you don't get to that stage and at least you have all your documentation in place. Now, in terms of the right of appeal, an appeal from the decision of the Commissioner General should be made within 30 days from the date of the decision of the Commissioner General to the Tax Appeals Tribunal. The Registrar of the Tribunal has the power to extend this, but this can only be extended once by a period of up to 7 days. Now, when it comes to the procedure before the Tax Appeals Tribunal, it's effectively a fresh hearing. So you're effectively what occurs before the Tax Appeals documentation is similar to what occurs in the Tax Appeals Tribunal, except this is a more formal process. In the Tax Appeals Tribunal, the taxpayer is entitled to call witnesses, as well as present documentation, and at the end, file written legal submissions. However, it must be pointed out, as Cabrini mentioned earlier, no documentation, no defense. Therefore, it's quite important to make sure that you're compliant in ensuring that you have a master file and a local file, and that your comparables are defensible from a transfer pricing perspective. Contrary to popular belief, lawyers are not miracle workers. So you need to make sure that at the point that you're going to the tribunal, you have all your documentation in place. And I think what is also quite critical is to ensure that even as at the point that you receive your assessment, you have your lawyers on board so that they are then able to follow all the documentation as well as the processes through the ZRA administrative process. It makes it then much easier when you come to the position of the Tax Appeals Tribunal and you then have to escalate it possibly to the Supreme Court. Mind you, transfer pricing is quite a technical subject. And so it is always useful to ensure that your advisors are on board from the very early stages, because they're the ones who would then have to put your position forward before the tribunal and possibly before the Supreme Court for something that is quite technical. So I think that is quite a key issue to take into account. Now, the appeal before the Tax Appeals Tribunal is required to be disposed of within 60 days of the end of the close of submissions. That is the legal submissions. You will have a hearing, and the tribunal rather, will typically give the parties directions on the filing of final submissions. From the date of the final submission, the tribunal is required to render its judgment within a period of 60 days. If you're not satisfied with the decision of the Tax Appeals Tribunal, a taxpayer has the right to appeal to the directly to the Supreme Court within a period of 30 days. Now, it must be pointed out here that the decision of the Supreme Court is final, and that is the apex court in Zambia. And when it comes to enforceability of decisions, in the case that you have a decision by the Tax Appeals Tribunal or the Supreme Court, as the case may be, that will be enforceable as any other judgment similar to a High Court judgment. And when it comes to the ZRA, they have various enforcement mechanisms. With regards to ordinary judgments, there's a limited scope for enforcement. You either issue a writ of FIFA or a garnishee, but the ZRA in their various pieces of legislation have strict enforcement mechanisms, which include garnishee provisions once they have an enforceable assessment. Unless there are any questions in the box, that would be all with regards to the dispute resolution process.
Okay, perfect. Thank you so much. It's quite a complicated process. It's important to be prepared for this. It's important to avoid it to the extent that we can. And it's important, as you say, you're not miracle workers when it comes to trying to resolve a dispute. If the homework's not done, if the documentation's not there, if the evidence isn't there, you're fighting a much more difficult battle that will ultimately end up more expensive. So just to wrap up, it's key to understand, what do you need to do from a transfer pricing perspective? Are you relying on group documentation Does that create any risk for you locally? Are you compliant with local law as well as with the OECD guidelines? Do you have the right documentation? Does your data and your numbers and your processes match what it says in your documentation and, of course, your legal agreements? And, you know, how can you improve the implementation and monitoring of transfer pricing into your business? So if we haven't started already, we say, you know, it's definitely time. One thing you don't want to get caught by is a massive compliance penalties for not have done what you're supposed to do. It's a difficult one to explain to your CEO, especially if your transfer pricing is all good, but you just haven't taken the kind of these compliance steps. So that's kind of the worst situation perhaps to be in. But I wanted to thank specifically our esteemed colleagues to join us. Transfer pricing comes with your technical experts as well as your strategic and legal advice. Well, that, you know, it's really important. It's a mix. It's a mishmash of both. It's not just a tax thing. It's a tax and a legal thing. And so we're really grateful to have MLP here with us. And to Malenga and Shim, thank you so much for your time. And I would like, and everybody for joining, we really appreciate it. There was over 100 people signed up for this. So obviously there are people worrying about transfer pricing, and we are here to help in any way that we can. I'd like to leave the closing words to you, Malenga.
Thanks, Cabrini. I think it's clear from this webinar that the importance of complying with transfer pricing regulations cannot be overemphasized, given the hefty penalties and also the potential reputational damage that may be done to a business. And you know, tax authorities worldwide are looking into this, considering that this has been implemented at OECD level. So it's quite important to ensure that you're compliant. And when faced with transfer pricing issues, both we would be available from a legal as well as a compliance point of view in assisting to resolve any issues you might have, including when it comes to disputes. And Cabrini and her team, as has been explained, would also be available from a technical TP point of view.
Perfect. Well, thank you so much. Thanks all. Appreciate your time. Thank you.